Abhishek, well, from banks to tech, JPMorgan, they have written an interesting note on what they expect from IT going forward. Reema, tell us more.
Well, their thesis is that growth is going to slow down. So they're saying for the IT companies, growth rates were in mid-teens. In calendar year 2023 and calendar year 2024, growth rate is going to slow down to 6 to 8%. As growth rates slow down, they expect a valuation derating, right? We've already seen valuation correct, but they are still higher than the historical levels. So here, JPMorgan has put out the current valuations versus the pre-COVID average valuations, say 3 years prior. And you would see the valuations today are still about 30% higher than those levels. That makes them cautious in the sector. So they have no overweights, no buy ratings. They've got 4 neutral calls, Infosys, Persistent, Tech Mahindra, and Emphasis, and they're underweight on TCS, LTI Mindtree, the newly merged IT company, HCL Tech, L&T Technology, and Tata Elxsi. And, you know, in everywhere where they're underweight, which is on 6 of the stocks, the target price is lower than where the current market price is. So thesis is growth rates will slow down meaningfully, and valuations will go back to the pre-COVID average valuation. So significant derating from here on, and this will play out over a period of time. So they're saying Q3 earnings miss you will attribute to higher furloughs. But in Q4 also, when earnings come out weak, then in April and May when the companies start guiding for FY24, again when you start getting weak numbers and a weak guidance, that's when the EPS estimates will start getting cut. So in the next 6 months, they expect this PE derating to be set in motion.
Okay, all right. JP doesn't believe it's yet time to get into IT names. Meanwhile, Jefferies, they're expecting operating leverage to continue to surprise for industrials this year. Vivek, tell us more.
Well, absolutely. So the one sector that I saw re-rating, in the last year on the